Burger King, one of the largest fast food chains in America and the world, is currently facing significant challenges. Hundreds of its restaurants across the United States are set to close in the coming months due to the bankruptcy of some major operators. The company's declining revenue and loss of popularity among consumers have led to a widening gap between Burger King and its major rivals, including McDonald's, Taco Bell, and Wendy's. In this video, we will delve into the factors accelerating the demise of this once popular brand. But before we begin, please support our work with a thumbs up and subscribe to stay informed about our upcoming videos. In 2023, 3 major Burger King operators have already filed for bankruptcy. These operators, located in Ohio, Utah, and Michigan, have been struggling with severe cash flow problems and a steep decline in foot traffic, sales volumes, and profits. Operating several stores at a loss for years, around 400 locations are expected to close their doors permanently this year. Additionally, the company's executives have taken action, shutting down 124 underperforming locations between January and May, with another 63 restaurants removed from its portfolio last month. Industry estimates indicate that approximately 10% of Burger King's 7,400 locations in America are likely to disappear in 2023. The closure of these restaurants reflects the escalating challenges faced by the brand. In response to the dire situation, Burger King's corporate executives are pressuring collapsing franchisees to sell their failing operations to other operators, rather than closing them outright. However, this strategy may result in substantial financial losses amounting to approximately $300 million. Last month, the company took a decisive step by joining a filing alongside creditors and vendors to force the sale of the remaining units managed by struggling franchisees. Burger King has deemed the franchisees' attempts at reorganization as ill-fated and insists on not allowing them to maintain ownership of the properties. Burger King's empire is in turmoil as it grapples with bankruptcy and declining popularity. The closure of hundreds of its restaurants, combined with executive interventions to salvage failing franchisees, highlights the severity of the company's current predicament. As the fast food landscape evolves, Burger King faces an uphill battle to regain its standing against its major competitors. Burger King, one of the world's largest fast food chains, is grappling with a serious crisis as it confronts bankrupt operators and declining financial conditions among its U.S.-based franchisees in 2023. As the parent company, Restaurant Business International, faces significant risk, Chairman Patrick Doyle emphasizes that selling troubled operations is the sole viable path they would support. However, if operators refuse to comply, the brand is prepared to take legal action to recoup approximately $10 million in unpaid royalties and advertising fees. Burger King's vast network of private franchisees plays a crucial role in overseeing restaurants worldwide. However, financial conditions have dramatically worsened for many U.S. operators this year, pushing them to the brink. This escalating situation has led to increased friction between corporate and franchisees, culminating in a threatening note issued by the company's board earlier this year. Chairman Patrick Doyle has taken a firm stance on underperforming franchisees, stating that they must exit the system. The company demands restaurants that consistently outperform the system average over the long term. Doyle emphasized that Burger King seeks to have its restaurants run by dedicated individuals committed to exceptional management. To achieve this, the company is willing to step in and utilize its balance sheet to temporarily run restaurants until they find suitable and capable owners. Legal actions are being considered to recover unpaid fees, while the company looks to sell off troubled operations to mitigate the damage. Chairman Patrick Doyle's uncompromising stance on the quality and performance of franchisees highlights the brand's determination to preserve its reputation and continue thriving in the fast food industry. Experts reveal that Burger King's woes can be attributed to various factors, including an inadequate response to digital trends, rising debt, and struggles in catching up with competitors. Prior to the COVID-19 pandemic, Burger King fell behind its rivals in terms of digital capabilities, leaving the company ill-equipped to capitalize on the surge in online sales during early 2020. While competitors enjoyed a cushion from increased profitability during the pandemic, Burger King lacked the momentum to leverage this opportunity effectively. The structure of Burger King's debt poses a significant constraint on the company's ability to finance expensive projects and upgrades for its U.S. franchise stores, such as the Reclaim the Flame program. With a higher net leverage than competitors, the company has limited room to take on more debt, particularly in an environment of rising interest rates. Rising interest rates have put immense pressure on franchisees, tightening credit conditions and causing financial stress. Labor costs, supply chain issues, and development challenges have exacerbated the situation. Many franchisees have lost access to development lines of credit and are in technical default due to exceeding lease-adjusted leverage ratios or failing to meet lending covenant criteria. While Burger King is investing in its Reclaim the Flame advertising and digital investment program, only 54% of its stores are participating in the modernization effort. Roughly 3,700 stores lack necessary improvements, as the program prioritizes well-situated or high-sales locations, leaving distressed franchise units with less support. Burger King's U.S. store profitability has been declining for over a decade, with annual revenues dropping by 36% between 2010 and 2020. The company experienced a concerning decline in revenue even before the pandemic hit, further exacerbating its financial challenges. The chain's sales performance has been lackluster, with a mere 1.1% growth in domestic same-store sales in June. This pales in comparison to its biggest competitor, McDonald's, which experienced a significant 15% growth in sales during the same period. Burger King's strategic shifts and promotions have failed to generate the desired boost in sales. Burger King's weak quarterly results and concerns about inflation have led to a sharp decline in Restaurant Brand's international shares. Without swift and effective measures, Burger King's struggle to regain its footing may continue to worsen. In recent years, Burger King has faced significant challenges, leading to a decline in system sales and market share. According to Technomic data, while Wendy's experienced a 4.8% increase in system sales last year, Burger King suffered a 5.4% drop to $9.6 billion. Wendy's, with 6,000 restaurants, outperformed Burger King's 7,500 U.S. units. Former CEO John Sell admitted that Burger King struggled to find the right value narrative for its consumers, resulting in a fluctuating approach to addressing value. This inconsistency was evident as they shifted from a $1 Your Way menu in December 2019 to a $5 Your Way menu by January 2023. In contrast, Wendy's focused on its premium made-to-crave lineup, featuring innovative offerings such as the pretzel bacon pub cheeseburger and jalapeno popper chicken. This strategy drove a significant 10% increase in incremental sales, highlighting the importance of value being linked to innovation and quality. Comparing to other big chains, Yum! Brands, the operator of KFC, Taco Bell, Pizza Hut, and Habit Burger restaurants, reported a 7% rise in net sales, indicating Burger King's potential loss of ground to its competitors. Market data from SR, a market and consumer data firm, shows that Burger King has become less popular among consumers. In 2019, it held the second spot in the ranking, but it has since dropped to the 6th position. With only a 1.2% share of the global fast food market, Burger King lags behind larger competitors like McDonald's, Starbucks, KFC, and Subway. Net profits have also been lackluster compared to its competitors. While Burger King's net profit stood at $1 billion in 2022, McDonald's profits skyrocketed to $7.5 billion, and Wendy's rose to $1.9 billion. Moreover, guest satisfaction declined by a significant 40% over the past 6 quarters, as customers complained about declining quality, limited healthier options, and rising menu prices.